Good evening. Welcome to the IFB. For those of you who haven't been here, welcome. A couple quick thank yous. First of all, to Algorithmics for sponsoring us tonight. They sponsor most of our operational risk programs. Also to PricewaterhouseCoopers for hosting this and many of our other events. A couple quick reminders as well. We will be recording this event. The video is only on the stage, but if you ask a question, it may be picked up on the background. And the videos will be online in our member section in a few weeks. And then lastly, make sure if you're not an IFE member to renew your IFE membership. We have several members-only events coming up. Our conference in June, which will be discounted or free for members, and all of our videos as well. Thanks.
Good evening, everyone. Hope you can hear me. I'm working off this. Check. Is that there? That's there? Okay. What a panel, what a time. How did they know when they scheduled this? The historic moment of the day, overarching and coloring a discussion of operational risk and the future of hedge fund investing. Can you hear me in the cheap seats? Okay, fine. I'm the dumbest one in the room, as I'm sure many of you know, but in going through this, it's certainly a great time, and I can think of no better way to color this than the space between January of 2002 and September of 2007. The notes look a little different. This from the Federal Reserve Bank of San Francisco. It's a nice once-over on operational risk in a different market and time and lack of leverage, and the linkage of those two ideas of credits and markets, and then Penny Kagan's article, which some of you or all of you have out of Algorithmics, and thank you for their sponsorship tonight, in a completely changed tone as she waltzes through 10 blow-ups, which we'll hear, I'm sure, some about today, from a varied list. I'm not going to go through the whole biography. Most of you know these guys better than I do, but I want to start with just a couple ideas. Andy has an extinguished career, and not only Bankers Trust and Nico, but has been in the trenches of the business. I was with Peter Carr and Bruno DePere today, and somebody tossed a chapter of a book at us about how to be a quant or how not to be a quant. When was that written?
That was 2 summers ago.
2 summers ago.
That it was written.
In another time. Leon Metzger, who I adore because he's one of the 12 people that listen to Bloomberg Surveillance, is working at Yale and Cornell and other schools, providing a needed perspective. And that must be a very tough job, bringing the law into a room of people that are really hungry to make a lot of money. And it's got to be every day a challenge. But forget about them. Stephen Brown's my favorite guy because the original sponsor of Bloomberg on the Economy was the NYU Stern School of Business. So thank you for being dumb enough to step up there when 12 people listen. So we're going to have a lot of fun. They're going to have like opening 5-minute comments, and we'll do the usual drill that you all know. Why don't we get started with Stephen Brown, because you're the one that brought slides, so you can wake us all up with a powerful PowerPoint.
I really appreciate the opportunity to come here.
Operational risk.
Yes. I had the wonderful timing to put together a paper with Tom Fraser who's in the audience and Bing Liang on the title of Due Diligence as the Source of Alpha, and came out the very day that the Madoff affair came to light. And this is in the context of one of the bullet points for this session as to what new techniques or investment strategies are coming out of this crisis as it pertains to hedge fund investing. And my take on this is that due diligence is like taking a medicine before you get to bed. It's something you do, but you don't kind of understand why you do it, and it's kind of unpleasant. But my take on this is a very positive take, that it is a source of alpha in a well-designed hedge fund strategy. And just to sort of give you some magnitude of what we're talking about, I just give you some numbers. If you look at hedge funds in general, there are of course diseconomies of scale. The larger the hedge fund, the more difficult it is to make money. But if you look at funds of funds, you get economies of scale, very significant, of the order of about 300 basis points. And when you try to investigate, well, what is the fixed cost which is being worked away through the scale? The only kind of fixed cost there is the due diligence, and you're talking about a fairly expensive process. If you look at private quality due diligence of a hedge fund, it costs at the order of $50,000, $100,000. And if you have 10 funds, which is an average fund of funds, small funds, and 26% of all funds of funds have less than $25 million under management, they can't do that due diligence and keep the lights on. And we looked very closely, and we found the very small funds of funds. Their auditors were strip mall accountants, and you get the idea that maybe these people were people like myself, professors who get an optimization program and some data and set themselves up as fund-to-fund operators. But there's some very simple data. We actually got to look at all of the ADV filings that all hedge funds made in January through July of 2006. We found that looking at those funds and looking at the ADV filings, that the problem funds, the funds that were most likely to have operational issues, were ones that were closely associated with broker-dealers. The Bayou Fund comes to mind, and of course Bernie Madoff this is his ADV filing, indicates his relationship with broker-dealer. And also internal conflicts. And this is looking at operational risk from a top-down rather than a bottom-up kind of perspective. The focus is in on one of the sort of the predictors of operational risk issues are conflicts of interest, and that's a sort of a very simple red flag that you can look for. We correlated these conflict of interests with other descriptive variables that people had found to be correlated with fund failure, and constructed a univariate small snowflake should be on the risk, and we found that operational risk was strongly correlated with negative performance, and of the similar order that we talked about before, and that in fact, when you actually look at operational risk and financial risk, operational risk turns out to be far better predictor of fund failure than financial risk, in the sense that, well, when you look at anybody who dies, their heart stops. Does that mean that everybody dies from heart disease? Not really. And the operational risk is, if you have very significant operational risk, what my research shows is that more than likely your financial controls are out of whack, and financial risk event becomes more likely, and that's very clear in the data. And so, in conclusion, I just want to emphasize, at least my work points to, while the bottom-up kind of approach, traditional approach to operational risk has a great value, even a top-down, very simple, looking at it from the level of the board down kind of measure of operational risk has considerable merit. Operational risk implies low return and higher probability of failure. What our research also shows, and this is really evident and comes very clearly to light in the Madoff affair, it does appear in our data, and this is prior to the Madoff affair, that knowledge of operational risk does not in any way mediate the naive tendency of investors to chase past return. And we argue very, and I hope persuasively, that in a well-designed, diversified hedge fund portfolio strategy, due diligence is a source of alpha. By simply excluding the obvious red flags, you're going to be make money. So that's basically my statement. Thank you.
Andy, why don't you go?
Okay. So I'd like to tell a little story that a friend of mine once related to me, and it's about what happens in the city of New York when there's a fire. what happens is that the police department dispatches a team of photographers that take pictures of the crowd sitting around watching the fire. And if you show up at more than one of the fires in more than one set of photographs, they actually come and get you. This is the true part of the story. The other part is that there are two people that always show up at every hedge fund fire, Mr. Mortgage and Mr. Leverage. And there's kind of a reason for that. It has all the elements of something that can go badly wrong. First of all, you're dealing with securities which lack price discovery, trade by appointment, that are priced using models. One of my favorite models is a model known as the PFA model. The polite version of that is pulled from air. I'll let you figure out what the other version of that is. The second thing is that when you're dealing with models, they're by definition wrong. They're just approximations. And some of them are actually involve the use of math, which is by and large a bit of a head herder for a lot of people. And unfortunately, in most cases, the people making the investment decisions lack the technical wherewithal to judge whether the output, the thing that's coming out of the computer, and by and large, you're dealing with a scenario where people believe trading consists of data, electricity, and then money coming out over here. They're unable to judge whether or not the output is meaningful or accurate. So that's kind of as a starting point. The second thing is, I just want to give you actually a few examples of things that I've seen for myself over time. I used to work for Bankers Trust, and Bankers Trust one year had an awful problem where one of their traders, who shall go unnamed, back in 1988 was able to put into his model his own implied volatilities for the purpose of valuing his large options portfolio, and overstated his P&L by $200 million just before bonus time. Another example, which took place at a large securities firm, which shall go unnamed but rhymes with feral Grinch, had a CDO risk model, which to me looked like an Excel-based spreadsheet, which described prepayments and default rates, and wherever you were in that little grid, that's what the thing was worth. And when I looked at it, I had a hallucination because I asked the trader, what if it goes over here? And he said, well, that's not on the grid. And I thought I was looking at a map of the world circa 1100, where you had Europe and a little bit of Africa and Asia, and out here there was dragons and goblins swimming around. And that was one example. The other one, which true story, one of the board members at Merrill became furious about the lack of controls in structuring the collateral pools into these what are known as warehouses, and was demanded to go and be taken to the warehouse. Someone who overheard this. Exactly. And the person that overheard this conversation was just that far away from saying, well, rents in Manhattan being what they are, we have to move it to Jersey. So the bottom line is you really need, in this day and age, the world has changed. You need staff that investment decision makers who basically have the technical wherewithal to evaluate things. And I from what I've seen at a lot of the institutions that I've been involved in, the sort of the key characteristic which guides whether or not you sort of move to the top as an investment and management professional relates to how well honed your scent marking and dominance behavior skills are, rather than a sort of a deep dive knowledge of the sorts of products that you're dealing with. And so that's always a big problem for me. Finally, you have to have the right business model in order to avoid operational risks. I have a partner in my business, a guy by the name of Walter, who founded the biggest market maker in listed securities. And I made the mistake of saying this when he was in the room once with a client, that Walter cares a lot more about his money than yours, but that's okay. And basically, for the purposes of investing his, $500 million, he chose to do it all through managed accounts. He chose to do it all where the trader only had the ability to make trading decisions and everything was electronically and immediately given up. He chose to run batch reports verifying for price and quantity that what was going on in his account was what was going on in a manager's main account, so it wouldn't be a repository for all the crap that didn't work out in the main fund. He chose to map every single security in almost real time, but or a T+1 basis, into 3 separate risk engines. And I got to tell you, having daily liquidity, daily risk reporting, and the ability to do those sorts of things, allowed him to sort of progress through the year without a single gate side pocket theft, and actually, make about 5% during the fourth quarter. So my hat's off to him. The other thing is that, and finally, I know I'm sort of eating into everyone else's time here, but
go ahead.
there's a lot to know these days about what it is you should be doing from a technical standpoint, and there's a lot of words that people are going to become familiar with shortly. One of the words, and this is actually when I learned never to talk to reporters, that I was having a conversation with a gentleman from Institutional Investor, and I was just basically making the point is that money, as money from plan sponsors flows into hedge funds, there's going to be, and effectively as money that is being invested by Joe Lunchbox, there's going to be a concomitant transference of higher order statistical concepts into the common vernacular. And when a teacher that's got their money invested through CalPERS watches their fixed income fund, fixed income ARP fund, make 1% a month for 36 months in a row, and they lose 40% of it, they're going to learn all about kurtosis, but right now most people think it's a skin disease. And he sent a reporter, a photographer to my office and took a really unflattering fisheye lens photograph of me and put a full page in there that said, living with kurtosis, so people want to shake my hand. But, the things you're going to need to know about in the future, you're going to need to know about techniques that are better able to describe for you the dependent structure in your portfolio and the relationship between securities in your portfolio and observable outcomes in the marketplace. You're going to need to know about co-integration. You're going to need to know about better ways of describing the dependent structure in your portfolio. You're going to need to know about copulas. You're going to need to know and really recognize that life is unfortunately out of samples, so you're going to need to know about resampled optimization. You're going to need to know that you're dealing with non-elliptical distributions, and therefore you're going to have to learn about conditional drawdown at risk as a proxy for risk rather than just assuming simple symmetry. So there's going to be a lot of things that people are going to know about eventually, but if you're going to be doing this business, you got to roll up your sleeves, you got to use best practices, and or just bad things happen to good people. Thank you.
Leon, go.
3 ingredients are essential to the success of hedge funds: trading strategies, capital, and good operational controls. While the first 2 seem to be pretty obvious, the third is equally important. A 2003 study by Capco of 100 hedge fund failures over a 20-year period concluded that 50% of them had failed because of operational risk, while 38% folded because of investment risk alone. Similarly, a 2007 study published by EdHec of 109 hedge fund failures over a 12-year period concluded that 54% of them had failed because of fraud, 13% because of other operational issues, and only 33% because of investment strategy. Unfortunately for many investors, due diligence begins and ends with the manager's performance record. There's a tendency for investors to chase returns, to assume that past performance guarantees future results, and to ignore potential operational risks. The payoff for many hedge fund strategies is a high probability of a small profit and a small probability of an extreme loss. Because it's hard to collect 2 and 20 on single-digit performance, advisors use leverage to amplify the returns. While I consider leverage to be an operational risk, I believe that others regard it as a financial one. Quickly, perhaps by show of hands, who in the audience considers leverage an operational risk? Who on the panel thinks leverage is an operational risk?
Only during bad periods.
When it comes
In
to
January, it's fine.
When it comes to operational risk, I do not see any fundamental distinction between hedge funds and the proprietary trading desks of other financial services firms, such as banks or insurance companies. Diversification, which reduces the risks of excessive concentration, is a necessary part of risk management. By way of illustration, assume a pension plan invests in a fund of funds, which in turn invests in 40 underlying hedge funds, each employing a different strategy. Is that diversification? With regard to strategies, yes. But what if the top-tier fund manager is a dishonest person? In such an instance, the lack of operational risk diversification may punish the investor. What about the investor in a multi-strategy fund that uses only one prime broker, which implodes? Again, there is strategy diversification, but not operational risk diversification. Now, some might think that hiring an independent third-party administrator is the solution to operational risk. An administrator offers services such as calculating the fund NAV. While it sounds great to add the administrator's extra set of eyes, investors may be lulled into relying upon a good housekeeping seal of approval type of endorsement rather than practicing good due diligence of operational risks. For example, in 1998, many thought that VAR was the panacea to the risk management issue. Fast forward 10 years to the amount of money banks lost in 2008. Or in 2004, the majority of the SEC commissioners thought that mandatory hedge fund manager registration would be a solution to a systemic risk and fraud. Yet the firm recently in the news because of a confessed-to Ponzi scheme was an investment advisor registered with the SEC. We have read that one of the feeder funds invested, whose money was managed account by that confessed-to Ponzi scheme, employed an independent administrator. The takeaway is there's no magic bullet to avoiding due diligence of operational risk. Whether it's VAR, or whether it's an investment advisor registered with the SEC, whether you have an independent administrator, you really have to do your own due diligence of operational risk. While we may not be able to undo the damage of the past, we, the greater IAFE family, should resolve to inform and educate investors regarding the benefits deriving from equally focusing on and diversifying both investment and operational risk.
Great. Nice opening comments. I want to again mention that the title is Operational Risk in the Future of Hedge Fund Investing, so we'll get to the future part right now. We've got a couple talking points that we discussed into this idea of excluding red flags, or in 2002, avoiding specific transactions, or the discussion of best practices, and my constant theme, which is to stop doing worst practices. If we go forward here, Andy, how do you get rid of worst practices within operational risk of the hedge fund? Who makes that decision? How do you affect an elimination of worst practices?
Well, there is the technique where you can spend time with your manager and be really, really nice to him and hope he does it. Or you can hope, or simply rather just take it out of his hands, which I think is where the world is going to go, where you have position level control and oversight, where you're actually allowing traders to make investment decisions, but you're not allowing them to control the movements of cash, you're not allowing them to self-administer, you're not allowing them to do anything other than decide what's going up and what's going down. And ultimately, that's the way the world is going to go. You're going to have all the positions being mapped into risk engines, and you'll be in a situation where they know that you know that you know that they know, and ultimately, that's where it's going to have to be. So if I had to point to one area where there's going to be an important development over the next 4 years, it's just having managed account platforms. As in the interest of full disclosure, we have that capability, but there are others out there that have been doing this for a while.
Professor Brown?
I think that
Maybe grab the microphone over there.
right.
Sure.
If we had a home economy, we'd have two. We'd figure it out.
I think too many hedge fund managers felt that lack of operational transparency was part of the business model, whereas it was an accident of a prohibition against general solicitation under the 3C1 and 3C7 exemption. The operational transparency has nothing to do with positions taken or strategies, and there is no excuse for the level of operational lack of transparency that's been evident in the past. It was interesting because I did a management education program at NYU back in 2002, and someone asked me whether Madoff was in my database, and I said, well, no, I don't have any data on him. He doesn't disclose anything to anybody. And this fellow gave me a very hard time. Well, that just proves that anybody's any good you don't have in your database, so that's why you get these kind of negative results. And I said, well, honestly, I would not trust anybody who does not want to reveal anything to anybody. And it was about 2 weeks later I got a call from the dean's office. He was laughing on the end of the phone. He said, I often feel that our professors don't have any impact outside the walls of the university, but in your case, I think I do have some evidence that your work does have impact. He said, I'm just off the line with the fellow who called me up and said, Brown is a dangerous man. He must be stopped.
Dangerously, Metzger, how do you move worst practices out of the sphere as we move forward?
Well,
Does Congress do it?
No, Congress doesn't do it. I think investors have to do it themselves. And I would go ahead and shamelessly endorse the AMA DDQ, the due diligence questionnaire, which really addresses these red flag issues. And if hedge fund managers were required by their investors will say, we're not going to invest unless you go ahead and fill out not the AIMA one, something comparable, and tell us who are your prime brokers? Where do you custody the assets? Answer all these questions. At least investors will have a basis for understanding that, and follow up and ask questions. Well, why aren't you doing it this way? Who does risk management report to? The traders of risk managers? Why? Why do all these red flags are addressed in this questionnaire? And I think investors took the time to read it. They have to require the funds, and if the funds don't want to fill out the due diligence questionnaire, investors should walk with their feet, not invest.
Another idea, I'm here. Another idea is transparency, and just for a little economic moment, I was at IMF G7 in Washington with the Deutsche Bank crew, and there was John Taylor up on the stage, he maligned by Alan Greenspan this week in the Wall Street Journal, and here's John Taylor fulminating about a need for transparency. 2 weeks later, I'm with Dean Baker, who's to the left of left, saying exactly what the former undersecretary said. We've got the right and the left in economics fulminating about transparency, and as we go forward, and to one of the talking points as we came in the room, this idea will suspended redemptions, gates, and lockups change investors' appetite. How critical is transparency, and what kind of transparency to jumpstart the industry forward again? Andy?
So, from a practical standpoint, there are a large class of what it is that hedge fund managers were trafficking in that defied transparency, where you were basically dealing with securities which didn't, essentially traded by appointment and were very, very difficult to value. So in those cases, transparency is generally viewed in a hedge fund or fund of funds community as more of a liability, because if you have it and you don't do anything with it, then it can create problems for you. And there are actually fund-to-funds out there who owned or had economic relationships with certain hedge funds that subsequently blew up, and it caused them a lot of grief. So, that's sort of one side of the coin. And just sort of to illustrate that, I actually got into trouble with the HR people at Merrill Lynch when I was there. Or I should say Farrell Lynch when I was there. And for using a certain slide that described my opinions about the ability to map every single security, regardless of the security class. And the idea was that you should assume that a hedge fund will give you full position level disclosure. You should assume that you can take every security in their portfolio and map it into a risk engine. And when you're dealing with complex OTC derivatives, it's very difficult to shoehorn some of those things into a risk engine. You should assume that the portfolio doesn't change during the period after which you manage to shoehorn everything in there. You should assume that you also understand everything in the portfolio well enough so that you can design all the appropriate stress and scenario tests. And while you're at it, you should also assume that you're King Leopold II of Belgium, because that's just as likely to be true. And apparently, he was a bad man, and they didn't appreciate that comment, so I had to change the slide. But it illustrates the point that it's transparency is a very difficult thing. Now, if you restrict your use of transparency and you restrict your investment to that class of securities which are both liquid and present you with highly idiosyncratic risk exposures rather than simply replicating expensively and in a non-transparent way traditional risk factor exposures, then you can actually gather from the hedge fund community a lot that is valuable. You can gather, most notably, complementary risk factor exposures that help you build out an investment portfolio properly. If you go with expensive betas and levered credit spreads, then you're going to have problems eventually. It's just a matter of time.
Professor?
Yeah. Yes, I hold a somewhat idiosyncratic view of this question. My sense is that anything you need to know is out there and available if you're willing to spend the money. I've seen the due diligence reports of about 500 hedge funds, many of them failed. And you can go into any level of detail that you can possibly imagine, down to the parking tickets of the principals, the positions, everything that you need to know you can pay for. And my sense of I've seen for example, I've seen the Amaranth report before the collapse, which listed any number of red flags right there in front of you, and of course you have to pay $100,000 for this. But I think of the people and the administrators of the San Diego pension fund, the public fund that sued them, and thought that these people must have houses on the ridgeline, in San Diego, and if they spent $10 million on their house, you think that they were paid a decent sum for an engineer's report that they didn't do for the hedge fund that they invested in. My sense, however, is that a lot of people in the President's Working Group report that came out in January 2007 indicated very strongly that their primary responsibility for hedge fund investors was on the fiduciaries, and a lot of these fiduciaries, like San Diego pension funds, nobody knew, nobody told us.
Okay.
How we know.
But then, to someone like me on the outside, you've got a conduit of hedge fund management, and within that operational risk,
Right.
and you go through to the middleman, the fund of funds,
Right.
and the investors. How deep does the transparency go? Does it just go to it didn't work with Madoff. I mean, you go to the fund of funds, and they're supposed to inform the investors at some level, aren't they?
They should, but then again, under prudent investor, you are the fiduciary still has a responsibility to see that the when he delegates those due diligence responsibilities to a responsible third party, like a fund of funds, that they are actually doing the due diligence that they're being paid for.
Except in this particular case, the providers of due diligence were actually being incented not to do the due diligence.
Correct.
Which is an issue. And also with Amaranth, that was actually, there's a sort of a dimension to that story which I don't know that everyone is aware of from a technical standpoint. One of the positions that created the most grief for that particular fund was essentially a calendar spread on natural gas. And the issue there is that the specific risk engine that they were using, which I'm not going to get into discussing, had a little bit of a flaw in it when it came to managing and describing the risk associated with calendar spreads. So instead of maintaining a whole series of separate time series on each of the individual contracts associated with a specific underlying instrument, they maintained a constant maturity continuous contract. So when you perturbed it, both of the options would go up and down at the same time, and there would be no noticeable risk associated with that position. And I found out about this because I mapped a calendar spread in, ran a stress test, and it showed no risk, and I said, I know that ain't right. And it was just a few calls later that I was able to determine that there was a way of physically forcing the kinds of answers you needed, but head office was kind of relying on a robust risk engine to ferret that information out for them, and it was saying nothing.
Leon, transparency?
I'm not the first one to say this. Many have said this, but often the manager says to the prospective investor, trust me, but won't trust the investor. I mean, it's an interesting observation. I believe that the hedge funds should have full positional transparency to the U.S. government or to the government of the home country. Let's say if it's a UK fund, UK regulators, including how much leverage besides the positional transparency. But I don't think the government should release that information to the market. That's number one. Number two, with regard to investors, I believe they should receive full transparency with regard to things such as valuation, policies, principles, practices, procedures. They should receive, at the minimum, transparency of the various risks that are involved, a number of reports, information such as if they're bonds, what are the ratings of the bonds, stress test results, portfolio. We don't have to go into all the details now. I think that often when managers say that the information is proprietary, the reason why they're saying it's proprietary is because, in fact, it's not real alpha that they're generating, it's fake alpha. And so investors should not be intimidated. They should demand transparency that they're comfortable with. And if they're not comfortable with it, they should not go ahead and invest.
Another idea that we can explore here, we'll go through about 2 more cycles here and then we'll take your questions as you can, is the idea of operational risk in within 2 broad categories. And I know there's subsets here I'm not up to speed on, but essentially is operational risk, obviously the answer is both, but is it a mathy solution or is it a cultural solution? My experience is that with a lot of hedge funds, they don't really want to confront either of those because they're managing money. It's fun to manage money, and who cares about this? But in the future, 1 year, forget about now, forget about where LIBOR, OIS is and the rest of it. I had to get that in there. You see how I got that in there? Good. But spreads are wide, the world stinks. We all know that. I'm sure half the room's making lots of money now, 2% a month. But within the reality we're in, forget about it. 2 years out, 5 years out, is a solution to operational risk in a better hedge fund community. Is it a mathy solution or is it a cultural solution? Andy?
Well,
Use the mic.
Oh, yeah, that's probably better. There's a little bit of both. The idea that risk reporting can sort of solve all your problems from a transparency perspective. Even with highly liquid securities, there's a lot that can go on during the course of the day that a manager can do. And a lot of the managers, that, especially those that have been doing well recently, are kind of very, very active and finish the day without much in the way of exposure. So you map the end of the day exposures into the portfolio, or rather into the risk engine, and what it shows is not a lot of risk, but they definitely have the ability to do stuff during the middle of the day. And the idea is there is it's almost like you have someone living in Westchester, and then during the day they, go to Cambodia and do things with the Khmer Rouge, and then come back home at night. And you say, okay, well, he doesn't have a very risky life. He lives in Westchester. But you have seen I have seen examples where that there's a lot that can go on during the course of the day where that evades a risking. So that's not your only answer. I do think that there's a role for both mathematical solutions. But once again, you have to be careful that the mathematical solutions don't become the source of your trouble. And one of the examples that I'm fond of doing is that there was a thing that every MBA learned. It was mean variance optimization. So you would use as your proxy for risk, some sort of trailing 36-month measure of volatility. You'd use as your proxy for expected return, trailing 36-month geometric mean return. You'd use as your proxy for the dependent structure, or some sort of a correlation matrix. And we did a little study where we sort of started 11 years ago with a 11,000 manager database, ran an optimization from the feasible universe at that time with that methodology, recorded what the portfolio looked like, let it step ahead 1 month, assume I could instantaneously rebalance, and took a look at the performance that was generated over time with respect to having the sort of mean variance optimal portfolio, and then compared that against the kinds of returns, as I'm fond of saying, that you would have obtained had you gone to Midtown to the Central Park Zoo and consulted the capuchin monkeys that lived there. And what you'll discover is that the monkeys actually outperform 70% of the time, which was my first major cost savings at Merrill. We just went there and got rid of most of the quants. You have to be careful that in certain cases your technology can be your undoing, and that an over-reliance without any kind of deep understanding of the shortcomings of the math that you're using can actually lead to worse outcomes. So there's a requirement that people be technically trained, understand the shortcomings of the math that they're using, and also have deep dive capital markets experience. You never leave a guy with a slide rule unattended with your money. That can be problematic.
Professor, do we need culture?
Actually, I think that's maybe a false dichotomy, because my sense is that, yes, I agree with Andy's position. In fact, I was at a presentation I gave at the KPMG headquarters in Australia, and I was talking about some of Andy's work on his St. Petersburg paradox material, and how traders could tidy themselves up and look great on a VAR criterion at the end of the day, and yet they live in very messy apartments. And I got heavily criticised by one of the leading banks, National Australia Bank, who said, they use value at risk. Of course, that's the standard of the art. I said, well, value at risk in this context is part of the problem, not part of the solution, because it gives you a false sense of security. And I was laughed out, and my 15 minutes of fame, of course, was 4 months later. I got a call at my home on Staten Island from one of the news television reports, because of course when I was speaking, there was indeed a rogue trader in that operation, which took them down $240 million and took the job of the president and risk management team and everybody. So, the quantitative procedures can indeed give you a false sense of security, and they're part of the problem, not part of the solution. On the other hand, if you the purely sort of cultural solution in terms of the way that operational risk management normally takes place, which is to go down to the smallest bank branch and look at the assistant treasurer and see what his family relationships are, and then sort of build up, get all of this data and coming to a central point where you come to some sort of synthesis of this huge amount of information about all the possible conflicts that all these low-level people have. You will miss the forest for the trees, and the fact that there's a conflict of interest at the level of the board can take the company out in an instant, and the reliance on all this information that's being collected in this in this very culturally sensitive way may in fact not tell you the story that you need to know. So that you need sort of more of a top-down approach than the traditional bottom-up kind of approach to this kind of problem.
In late December, UBP, which might be the second largest fund-to-funds manager, I think perhaps about 30 billion of capital under management, announced that it intends to withdraw from any fund that does not use an independent administrator and custodian. Guess what? Some of the funds in which invested are the most prominent, largest hedge funds in the world. They're caving in. They're they're following the requests because they don't want to lose the capital. I think it's cultural, and I think if investors demand it, it will happen.
One final question, we'll go to questions and answers and get them ready. There was a book I read years ago, Iceberg Risk, Ken Osmond, which was great. They got the Titanic, and it's two people, Jack and what's his name from the movie, and they're on the front of the ship, and they're going through the water, and Kent does his magic. And there's been a lot of icebergs the last 18 months, or at least the iceberg's pretty big, including the drama we saw today. Maybe there's no bigger iceberg, and there's so much going on, I don't think it's going to be part of the financial ministers meeting this weekend, or even G20 April 2nd in London, but certainly in Europe, there's a whole forward push here that I'm not hearing in America on operational risk. Okay, let's say the Europe thoughts come over to America. What should be the government role here, Andy, as we move forward into the futures of a hedge fund? How can the government constructively get into operational risk?
Right. So I heard one comment that you couldn't tell if there was going to be a bull market in equities or a bear market in fixed income, but you did know that there would be a bull market in regulation. And that may well be the case, but you have to be very careful. I think the single most important thing that, from a regulatory standpoint, they could insist on is that you have an independent administrator at the security level. I can't really think of one example where there's been a major fraud where that has occurred. And so, if you wanted one simple rule, that might be it.
I think that people again are looking for a false sense of security in the ability of the government to look after their interests, and ultimately it's in the individual's responsibility to do that. The Madoff affair shows clearly. If you go back to even the example of Charles Ponzi back in 1920, one of the characteristics of his operation was capturing the Boston Police Department and making sure that they were all very heavily invested in his scheme. Bernie Madoff and his family had important part of their responsibilities were to attach themselves very closely to the regulatory bodies
and marry them if necessary.
And marry them if necessary. Marrying them if necessary. In the case of Stanford and regulatory issues down in Antigua and in Venezuela, there seems to be a pattern here, so I think that ultimately you cannot. Just as investors were mistaken to put their faith in the due diligence capabilities of fund of funds, I think they're even more mistaken to feel that regulation by itself will protect them. I think ultimately they have to do the job themselves, and they cannot be excused from that responsibility by pointing to the fund of funds or pointing to the SEC. They failed, therefore we need to be made whole. I think people have to stand up to the individual responsibility, and it's an individual responsibility that can be met because there is nothing that you cannot find out about any hedge fund or any hedge fund operation as long as you're willing to spend the money to do so.
Yeah, quickly.
I see the primary role of the government to educate and inform investors as opposed to enacting rules, because rules always can be broken.
I will say, however, one exception is when we testified in late January before the House Financial Services Committee, Columbia Law School's John Coffey said that there's never been a Ponzi scheme with a mutual fund, and he believes because they have independent custodians. And so I would say, and we certainly have had hedge funds that have had issues were Ponzi schemes because they didn't have independent custodians. So maybe that's one rule. But basically, it's educating and informed investors.
Let's get to questions and answers, because the distance between you and the cocktail party is your questions and answers. So let's get to them, make them fast, quick. Just, quick questions. Go. No questions. Cocktails. Okay, in the back.
Other types of
You'll have to speak up. We all have rock and roll ears.
in other types of activities in the world where we apply engineering, we tend to demand that there's equally precise alternative measurement schemes that are used so they can be compared. And based upon those kinds of activities, they at least can learn from their mistakes. An example was the first Apollo landing on the moon almost landed 40 feet in the air because of an error that wasn't done by the compiler. But they did have two computers. At that point in time, they demanded two separate languages as well. You don't seem to be
Tend to look at a whole battery of them. So you look at concentrations, you look at scenario tests, you look at predictive stress tests, you look at bar numbers, and if you're smart, you look at them more ordinally than cardinally, how they're migrating. So, you do a bunch of that stuff. In addition to that, if you're doing it right, you're taking your individual managers and you're effectively attempting to reverse engineer their trading strategies and testing to see if what they're producing in the way of returns is consistent with the understanding that you have about what it is they're producing. So if you're doing it right, there is a lot of belts and suspenders and those sorts of things going on. But not everyone does it right, or even thinks about how they should be doing it right. Because the truth is that there's only one free lunch in finance, and that's diversification. So if you whack together a highly diversified hedge fund portfolio, essentially replicate the indices, then you can get back to job one, which is just being an asset gathering organization rather than an asset management organization. And I can't help but think that that's how a lot of it's done. So there's just hoping things don't go wrong.
I think that for too long people thought of risk only. I agree with you. I think that people thought of risk only unidimensionally in terms of financial risk, and that's what they concentrated on. There was the wonderful case of the Chicago Art Institute case back in 2000, where so it's almost like I teach these students. Some of them, one student, they're really aggressive kids. One of them says, "If you're so smart, why aren't you rich?" And I looked at this kid and I almost said, well, if you're so rich, why are you so dumb? I didn't. But that's what I wanted. And you've got the richest people, richest men in Middle America were on the board of the Art Institute of Chicago, and they bought this line of market neutral mandate for this hedge fund, and of course they lost a large portion of the endowment, and they complained, and the guy said, "Well, I told you I was giving you a market-neutral mandate. The market went up, I lost everything." Well, that's what we mean by market neutrality. And your mandate was so broad as to allow me to invest in the Super Bowl pool. And you could think, well, gee, this is a great idea. We've got a number of people in this room. We could set up a hedge fund. We could collect an asset gathering organization together. We could raise easily $100 million. Split into quarters, take it down to Atlantic City, and play the slots. We probably wouldn't make any money, but hey, the return would be completely uncorrelated with the S&P 500. So, market-neutral strategy, no risk. People just didn't ask the right questions. They looked at risk as solely financial risk, and didn't ask the important questions, which you would ask of any other any other managed fund. How are you doing your business? What kind of operational issues, are in the business? What's the key man risk? What if your principals, run down by a truck? There's sort of basic questions which you would ask of any sort of long-only manager. People stopped even thinking about when they came to hedge funds, and that's a very important issue.
Next question, let's go to Rick.
We've got the U.S. government guaranteeing some hundreds of billions of dollars of liquid assets from different banks. My question is, what are the operational risks inherent in this program? Is this not just another giant hedge fund that the government is building up? And if so, would they be abiding by the same rules? Or are they saying trust us with the government, like the manager would be saying trust me, I'm the manager, and doesn't trust the investors?
I've talked to Bill Isaacs about that. It's an interesting question. How do you set up operational risk for TELF, TARP, and the other 8 algorithms, and the ones to come?
Seems like the government's making up things as it goes along. Exactly what its strategy is. So until the government figures out exactly what it's going to do, then it can start figuring out how to deal with the operational risk. But you can't solve the operational risk issue if you don't know what you're doing. And do you think the government knows what it's doing?
I think there are segments of the government that knew what they were doing.
But
doesn't necessarily mean they were acting in everyone's best.
Didn't Paulson tell Congress we're going to go ahead and buy what was formerly known as toxic assets, now known as legacy assets? Right? When that happened, that money went to pump up. That was additional capital in the banks. I mean, you talk about operational risk about these legacy assets. That has nothing to do with the operational risk of putting more capital in banks.
Style drift.
Sir.
We haven't heard about too big to fail. Is that operational, systematic, or isn't that a valid? It's really something we depend on the government for. Is not let them get too big, because we all have to pay if they do.
I'm not really an economist. I play one on TV, so we have one right here. But back in graduate school days, when I was studying, rational expectations, econometrics, there was a lot of papers that were being written, by really smart guys, Sargent and Lucas and so on and so forth, that basically made the point that if you have a central monetary authority that essentially has the same information set as the market, that any attempts to constrain volatility will actually create this feedback mechanism such that volatility ends up ultimately being exacerbated. So that's an issue. Now that's one way of understanding. So I think if you went to basic principles, you'd probably come to the conclusion that while there are free marketeers in a foxhole during an economic crisis, that's all well and good. But I can't help but think that this is a huge moral hazard issue. And there was a paper that was written and published, I remember the day, November 17th, 2005. And it was written by just a brilliant guy. He was a very nice person, a fellow by the name of Hunt Taylor. And he was observing what was going on at the time in the marketplace and commenting on the issues that Greenspan was trying to explain away. Why is it that credit spreads were effectively so tight? Why is it that the market wasn't pricing in risk the way it should have been? And he made he said, well, it's sort of being explained to the world as a function of the advent of financial engineering, where you've been able to take what was typically risk that sat on the balance sheet of banks and insurance companies and more broadly syndicate it, such that for any given level of risk in any objective sense, the overall economy was now significantly more stable. And he said, that's all well and good, but you have to understand that automobiles are very much like that. And he invoked this notion of risk homeostasis, constant risk. And he talked about cars, and he said, look, cars today They got side impact airbags, rack pinion steering, anti-lock brakes, and by any objective measure, they are safer than they were 30 years ago. But guess what? Humans adjust for that by driving a whole hell of a lot faster, and so we actually are no more safer today than we were previously. And subsequently, 3 days later, he was fired for having invested in Bayou, and a month later, run over by a truck. So I mean,
I want to mention, Professor, I want to go to you on this, but a new paper by, I think it's Andrew Hardiman out of the Bank of England. It is a spectacular paper from the one you just cited. It was cited by Martin Wolf and the FT, and it is spectacular. It's funny. It's also got some serious weight to it. I believe it's Andrew Hardiman out of the Bank of England. I'm sure you can find it there. Professor, a comment?
Right. A good friend and mentor of mine, Stephen Ross, up at MIT, made an observation a few years ago at a conference that when we try to design appropriate incentive mechanisms where the cheese was put in exactly where you don't want the executive to go, and that inappropriate, unpriced insurance for the Freddie Mac and so forth. You had this environment where these luscious returns to hold in this subordinated paper made it just too tempting, which should have been passed on to the hedge funds, but they kept it for themselves because they wanted to earn those returns instead of those greedy rich people.
Sir, ready.
With the new apprehension and understanding of the market and operational risk, how it's going to change how hedge funds invest? They're going to have to be more transparent. How is it going to affect them? Do anything different?
Yeah.
Well, in terms of how they invest, it shouldn't really change. If there's an economic profit to be made, the fact that there's operational risk, that you're going to be more careful about I don't see that any changes.
I think that there's been a bait and switch here. The industry, the Bulldog Fund, and those people tried to put out the idea that transparency meant that we had to reveal the crown jewels about our trading strategies and positions, whereas in fact all of the SEC ever wanted to know, investors to know about was the strictly operational issues, which many hedge funds were unwilling to provide. We're going to a world where that just is not going to fly anymore.
There's a lot of crap that gets served up in the hedge fund industry, in particular when it comes time to marketing things. So one of the things that I have learned is that when a manager tells you he's closed, that means he's open, and when he tells you he's open, that means he can't raise money. And and one of the classic examples of this, I was talking to one manager out on the West Coast who confided in me that his wife was a psychiatrist, and when he had only $180 million under management, she came to him and told him that he would never be successful at raising money until he closed his fund. And within 18 months after closing the fund, he went up to $2 billion. So there's this issue of creating an allure that tends to attract people. It's people think supply and demand and price, and but it's you can sell anything as long as you charge enough. And there's a lot of issues that motivate people to do things that aren't necessarily in their best interest. But ultimately, I think that performance will improve, that people will not confuse someone who's effectively making a living by assuming the risk of a low probability event and essentially taking in a premium as a function of assuming the risk of a low probability event, who have no exit strategy when things go badly, as being a source of hedge fund profits. It's not. It's basically just restructuring payoffs to fool people and taking advantage of an incentive structure which closes at the end of every year, and where an incentive fees, which by and large you don't have to give back.
Leo?
But I think the allure is ending. I think it's like the Wizard of Oz, where the curtain's been pulled back. In light of what happened in the middle of December, I think investors are really asking tough questions now. Should I be invested in a hedge fund? Because I don't know how the manager makes money. And I think they're asking these questions because they've seen what has happened to very sophisticated investors, people who, they looked up to, and if it could happen to them, if it could happen to those sophisticated investors, it could happen to these investors themselves. I think the allure is over. I don't think we're going to be living in the same type of environment anymore. It's finished.
I also want to raise one issue. There are a lot of very small hedge funds out there, a lot of really marginal operations. In fact, I looked at the Tremont Task database just recently, just before the remarkable events in the middle of last year. There were 13. A quarter of all hedge funds had less than $13.5 million under management. Now that's scary. And you have all of these hedge funds out there who are just
One of them was Bernie Madoff.
well, we're really exactly, if you actually look at the real assets, exactly. But there, and you wonder what were people thinking? What were people thinking? Those are the funds that are not going to have any kind of operational controls. And you're just looking at a disaster. Why would people willing to put their money into these really tiny funds? Those are the funds that are going to be swept away by this current hurricane. And good riddance.
One more question. Who's got one? Sir.
So we conveniently divide risk into three categories: market risk, credit risk, and operational risk. However, there are risks into which it's difficult to see how to categorize. For example, you can do, at a given institution, you can look at market risk, operational risk, and credit risk and think you've got everything under control. Systemically, across all financial institutions, you have collective behavior, you have risks that you cannot see by looking at individual trees that are present in the forest. How do we deal with that?
I'm not 100% certain I understand the question. What would be like a great example of risk that doesn't fall into any of those categories?
I think it's just talking about
Structural in nature.
systemic-
Systemic risk in the marketplace? Yeah.
Another good example is psychological panic.
Yeah. Systemic risk is a wonderful trading opportunity if you have the right group of people. There are trading opportunities that are just that live for systemic risk. I mean, we have one manager that we like to use who does nothing other than capture serial correlation at the short end of the U.S. and European yield curves. And you ask yourself, why would you do that? And first of all, you would do it because it's one of the richest anomalies in trading space, because central banks tend to adjust interest rate policy in a highly serially correlated manner. When the Greenster took rates from 1 to 5.25, how did he do it? It was 25 basis points every 6 weeks, 17 times in a row, as part of a social welfare program known as No Trader Left Behind. So it's a very rich anomaly. And beyond that, its peak periods of performance tend to coincide with those periods where the hands of the central banks are forced. They cut rates dramatically and persistently, and that's a manager who was up 39% last year net of fees. So that's one of the things you think about, and you think about what needs to be in a portfolio in order to get the kind of results that won't get you fired.
Let's do any other comments? I got one idea here. I hate to bring this up, but heaven forbid everything gets better. Does this debate go away if we get, like, you tell me, 3 years of normal back? Does everything we're talking about sort of filter away?
Back in 1998, when long-term capital management imploded, there was a shift in the landscape of hedge funds in terms of risk management. Hedge funds poured more money into it. They hired people. The chief risk officer, none existed before. They hired a chief risk officer who reported to CEO. They improved the computational aspects. That didn't go away, even though hedge fund performance improved after 1998. It was there to stay. I don't think it goes away. I think there are too many people who have seen what can happen when you don't have a handle on operational controls, and I think it's permanent.
Professor?
you think?
Yeah, I think it's very clear that a lot. What's changed is very much the competitive environment has changed for hedge funds. It was very interesting in the Managed Fund Association fought bitterly against the SEC requirement that hedge funds register as financial advisors. They fought it tooth and nail, and we cheered when that was finally beaten down. But then, very sheepishly, in the March 1997 congressional hearings in the House Financial Services Committee, the witness for the Managed Fund Association admitted that even though it was not actually required, all of their members still registered as investment advisors and submitted the required Form ADV. It was now sort of competitive requirement. In fact, if you look at all of the sort of the private investigator reports that I've seen after the hedge fund requirement of registration, there's a checkbox up on the right-hand corner. Did you file Form ADV, and why not? If not, why not? And so, in my sense, it's like, you know, I guess it was the Islanders that had fought bitterly in ice hockey wearing the helmets, and everybody fought it because wearing helmets was a competitive disadvantage. But then they finally, the government had the guts to require all ice hockey teams to wear helmets. And now everybody happily wears helmets, and I don't think there'd be any sort of appeal against that, because now there's no competitive disadvantage to wearing helmets. So
in fact, you could actually turn that into a competitive advantage.
Exactly.
By saying that we are focused, we're committed to operational
Absolutely.
control. We're better than the people down the block.
Exactly.
Well,
You'll see the
although
best.
the flaw in your argument, and there was an article in the FT about this that showed that people who have organic brain damage actually make better risk-neutral decision makers.
We'll leave it there. The operational risk is we've got to go to the cocktail hour. Thanks to all of our panelists and, of course, the